Imagine waking up tomorrow and checking your bank account. The number has not changed. Your $100 is still $100. But something feels wrong. The new phone you planned to buy costs far more than it did yesterday. Fuel is rising. Imported food is more expensive. A holiday abroad suddenly feels unaffordable. And every news channel is repeating the same frightening sentence. The dollar is collapsing. Poor Stick panics. He empties his bank account, buys gold at a record price, puts the rest into a cryptocurrency he barely understands, and waits for the end of the financial system. Rich Stick does something less exciting. He asks one question. What does the dollar collapsing actually mean? Because that phrase sounds precise. It is not. And before you can understand what happens to your money, you need to know which kind of collapse you are talking about. People often mix four different events together. The first is an exchange rate collapse. The dollar falls sharply against the euro, yen, pound, and other currencies. The second is an inflationary collapse. A dollar still buys things, but it buys much less inside America. The third is a debt market crisis. Investors begin demanding much higher interest rates to lend money to the United States because they are less confident about future inflation, fiscal policy, or repayment. And the fourth is the loss of reserve currency dominance. Central banks, companies, and investors gradually use fewer dollars for saving, borrowing, and international trade. These events can reinforce one another, but they are not the same. The British pound lost its leading international position gradually over decades, not in one morning, and a currency can fall without producing hyperinflation. Federal Reserve research found that currency crashes in advanced economies have been associated with severe damage, mainly when driven by inflationary macroeconomic policies. So the real danger is not simply a red line moving down on a currency chart. It is a collapse in trust. Now for the reality check. As of the first quarter of 2026, the International Monetary Fund reported that the dollar represented 57.13% of global foreign exchange reserves. That was not a collapse. It was actually slightly higher than the previous quarter, although exchange rate valuation effects explained around half of the increase. The latest Bank for International Settlements survey found that the dollar was on one side of 89.2% of currency trades in April 2025. Every one of the 10 most traded currency pairs involved it. Federal Reserve research also shows that the dollar dominates international banking, foreign currency debt, and much of global trade invoicing. Even about 99% of stablecoin market value was dollar-linked in the Fed's 2025 review. So no, the evidence does not say the dollar is disappearing tomorrow. But there are real warning signs. The Congressional Budget Office projects that federal debt held by the public will equal about 101% of U.S. economic output in 2026, and rise to 120% by 2036 under current law. Net federal interest costs are projected to exceed $1 trillion in 2026. That path is not proof of imminent collapse, but it reduces the government's room to respond to future crises. The dollar is dominant. It is not invincible. So how could a genuine crisis begin? Imagine that investors become convinced that US debt will keep rising faster than the economy. They begin to fear that future governments will deal with that debt through persistent inflation rather than taxes or spending restraint. Some investors reduce their treasury purchases. To attract buyers, bond yields rise. Higher yields make mortgages, business loans, and government borrowing more expensive. Government interest costs rise again, making the fiscal problem worse. If the central bank then appears to hold interest rates too low simply to make government debt cheaper, inflation expectations can rise. More investors demand protection, the dollar falls, imports become more expensive, inflation increases, and confidence falls further. That is the dangerous feedback loop. But notice the ingredients. Large debt is only one of them. A full crisis would normally require deeper damage, persistent inflationary policy, loss of central bank credibility, default fears, weakened property rights, capital controls, or a much more attractive alternative currency. Reserve currencies survive because of networks. People use dollars because everyone else uses dollars. Breaking that network takes more than a scary headline. If the dollar fell sharply, the first effect would not be that your bank balance vanished. It would be that your money bought less. Imported electronics, machinery, medicine, clothes, and foreign travel would become more expensive. Oil and many commodities are traded globally in dollars, but their real cost is set in world markets. If the dollar lost purchasing power, American buyers would likely pay more. Companies using imported parts would face higher costs. Some would raise prices. Others would reduce hiring or accept lower profits. The Federal Reserve could raise interest rates to defend price stability. That would make new mortgages, credit cards, car loans, and business financing more expensive. Asset markets could become extremely volatile. Long-term bonds would likely fall if investors demanded higher yields. Stocks could drop at first as financing costs rose and consumers cut spending. Banks and funds holding large quantities of long-duration bonds could face losses, yet American exporters might become more competitive because their products would be cheaper to foreign buyers. Tourism into the United States could rise, and here is the strange part. At the beginning of a global panic, the dollar might rise before it falls. So much global debt and trade is denominated in dollars that frightened institutions often scramble to obtain dollars during a crisis. That happened during previous global shocks. A reserve currency crisis may not move in a straight line. Panicking assumes that every investment measured in dollars becomes worthless. That is not how it works. Cash and fixed payments suffer when inflation rises faster than their return. A $10,000 bond still promises $10,000. The problem is what those dollars can buy when they arrive. Someone with a long-term fixed-rate mortgage may receive an unexpected advantage if wages and prices rise while the dollar value of the mortgage remains fixed. But a person with variable-rate debt could be crushed as interest rates rise. Businesses with pricing power, productive assets, and foreign earnings may adjust. Companies dependent on imports and cheap borrowing may struggle. Foreign stocks can rise in dollar terms simply because the dollar is weaker, but they still carry business, political, and market risk. Real estate may benefit from higher replacement costs over time, yet high mortgage rates can push property prices down in the short run. Gold has often been used as a monetary hedge, but its price can be extremely volatile. Crypto is not a guaranteed shelter either. In a panic, speculative assets can fall precisely when investors expect them to save the day. There is no perfect collapse-proof asset. There are only different risks. A dollar crisis would not stay inside the United States. The dollar is woven into global loans, bank deposits, trade invoices, and foreign exchange markets. Countries and companies with dollar debts would experience a complicated shock. If the dollar weakened in an orderly way, some foreign borrowers would find their dollar debts easier to repay in local currency terms. But if dollar funding markets froze during a panic, the immediate shortage of dollars could hurt banks and companies around the world. Central banks might intervene, draw on swap lines, sell reserves, or raise interest rates. Commodity exporters could demand a wider mix of currencies, while trade would face higher conversion and hedging costs, and the replacement might not be the euro, yuan, gold, or Bitcoin alone. The world could move toward a fragmented system using several currencies. That would reduce America's special advantages, including lower transaction and borrowing costs. But it would also make global finance more complicated for everyone. So what should Rich Stick do? Not predict an exact collapse date. Build resilience. Rule 1. Keep an emergency fund in safe, accessible accounts. Inflation can erode cash over time, but emergencies require liquidity. A perfect long-term hedge is useless if you must sell it during a crash to pay next month's rent. Rule 2. Understand your debt. Know which rates are fixed and which can reset. High interest and variable rate debt can become dangerous when interest rates rise. Rule 3. Diversify across sources of return. That can include broadly diversified businesses, international exposure, different bond maturities, and inflation-linked securities such as TIPS. TIPS are designed to adjust their principal with US inflation. They are a tool, not a magic shield against every kind of institutional crisis. Rule 4. Own productive capacity. Skills, a resilient career, a useful business, and assets that produce goods or services can adapt when the unit of measurement changes. Your ability to earn is one of your most important assets. Rule 5. Avoid panic concentration. Putting everything into gold, one foreign currency, one property, or one cryptocurrency replaces one risk with another. If your plan only works under one dramatic forecast, it is not a resilient plan. Poor Stick tries to guess the one asset that will win. Rich Stick builds a financial life that can survive several possible futures. The dollar's share of global reserves has declined from its early 2000s peak. Other countries are experimenting with new payment systems. America's fiscal path deserves serious attention. But a slow movement toward a more diversified currency system is not the same as an overnight dollar collapse. For the dollar to lose its central role, the world would need both a powerful reason to leave and a credible place to go. The euro has political and market fragmentation challenges. China's currency is not freely convertible, and its capital account is not fully open. Gold cannot operate a modern credit system by itself, and most stablecoins currently extend dollar usage rather than replace it. The greatest lesson is not that collapse is impossible, it is that dramatic predictions hide important details. Wealth is not protected by panic. It is protected by liquidity, diversification, productive assets, manageable debt, and the ability to adapt. If this video helped you understand the system behind the headlines, subscribe and share it with someone who thinks the dollar will either rule forever or disappear tomorrow. Both stories are too simple. This is rich stick, poor stick. Building wealth, one wise decision at a time.